Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome back. You're watching Traders Corner, and joining me as always every Tuesday evening is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, G. Later.
Garth, we're going to have a top 40 spectacular this evening. So I know that you want to discuss where we are at the moment in the market, and also with a special regard to the top 40 option structure that you put onto the portfolio a few months ago. Futures closeout's going to be happening in a couple of days' time. So what do you see developing at the moment?
Yeah, all right. Well, what I've got on the screen now is a chart of the top 40 future. This is the September top 40 futures chart. It's a daily chart. So what it means is that each one of those candlestick plottings that you see on the graph there represents 1 day worth of trade. And it goes back a year effectively. So that at the bottom over there is July 2013. And you can see there's quite a nice steady rising trend that comes through all the lows over the last year or so. And we're back at an area now where our market's been consolidating over the last 2 months or so. And we're getting close to this rising trend again. It comes in at around about 45,000 or thereabout, which is the round figure. And you can see that really since the middle of June, actually, our market's mostly just gone sideways. Yeah. It hasn't really made any headway whatsoever. And it has been underperforming the rest of the world's markets quite badly, well, particularly the US markets, let's put it that way. The S&P 500 is continually making new highs at the moment, whereas our market is languishing quite a long way below, not a long way, but we're more than 1,000 points below our all-time high at the moment.
Which is quite weird because we normally track the S&P 500.
We do normally track it quite closely. So that's what kind of a little bit concerning for me, is that we are underperforming. If we were to see a pullback on those US markets, I think we would be quite vulnerable to a deeper pullback in our market as well. But having said that, we do have this uptrend support which comes in at about 45,000 on our top 40 future. And one might even argue that this channel that we've seen over the last 2 months or so is quite a healthy little consolidation type pattern, which might very well end up breaking to the top side at some point and lead to another strong rally into the end of the year. It's quite possible, but I think for now we're a little bit cautious on our market. I did allude to some of this last week. I spoke about the DAX, which was looking vulnerable, and so on. So I think by and large we're still erring on the side of caution for our market in the short term. Interestingly is that this area around about where we are, just below where we are, basically between 44,700 and 45,300. There are lots and lots of options strikes, put option strikes specifically, that have been written in that area. There's a total of around about just over 20,000 put options that have been written in that area, which equates to about 9 billion rands worth of market exposure. Sure. Now, you alluded to the futures closeout coming up. It comes up on the 18th of September, so it's 2 weeks away, or it's basically 13 trading days away from where we are now. What's quite interesting is that because we've got all of these options, these put options that have been written in that zone, which is a little bit lower than where we are now, it kind of brings that potentially into play in a big way in the next week or two as we lead up to the futures closeout.
When you say it brings it into play, do you mean it actually having all those put options written there could prompt a sell-off? Because they are kind of hedges against a sell-off, but could it actually cause a sell-off to occur?
Well, it could. What could happen is if we get weakness in international markets, that obviously translates back onto our market where we see a little bit of selling. If we start getting into that zone where all of those options have been written, you could very well find that the banks that are net written on those options actually need to sell in order to hedge themselves. And to explain how that works, obviously there's 20,000 put options that are out there that have been written, but there's of course a long put for every short, or a short for every long, right? Yeah. The thing is that if you're written on a put option in that area and the market starts to fall into that zone, then what the possibility then becomes is that you, as the bank, let's say, that's written those options, would be ultimately you're allowing someone else effectively to sell at the higher price where the strike is. It forces you to be a buyer, in other words, when that option gets exercised. In order to mitigate that risk of being forced to effectively buy futures at a higher price than what the prevailing market level is, you would then go in and actually sell futures short in order to hedge that options position. So what it could effectively mean is that if we do see weakness in our market during the next week or two into that zone, you could find that there is a bit of accelerated selling pressure as a result of these options needing to be hedged. So that's something that we just need to keep in mind for the next week or two as we lead up into the futures closeout. It might happen, it might not happen. I mean, I don't know. But I do still think we're quite vulnerable. And certainly if the market starts to fall into that zone, I think we need to be careful because there could be some fun and games
You
on
call
the
it
downside.
gamma selling.
Yeah,
that's the sort of the trader's term.
Well, that's what the term for it, which is.
What does that mean?
It's a Greek term. I mean, gamma is a Greek term. You've got all these Greek terms with options: gamma, delta, theta, vega,
alpha,
all these
beta.
alpha, these things, which are probably beyond the scope of this show to discuss. So I don't want to go into that level of detail.
It's all Greek to me, I have to say. Anyway, okay, so that's an area to watch. And with the futures closeout coming out, well, as you say, on the 18th of September.
Yeah.
Guys, now we took out an option on the market trading weaker, and it expires essentially at the September futures closeout. So maybe you want to go and revisit that trade and why you did it.
Yes, I do. I want to go back and have a look. Now, we did this trade in May, so we've had it on for a number of months now. But this option structure that we did then will expire with this futures closeout now in September. So I want to just have a look at it and revisit this quickly and explain where we stand, because there's still a possibility that this structure might work for us, or we could even use it as a hedge to buy against. But I'll talk about that. But first of all, let's have a look at the structure, how it was constructed. Now, on this chart over here, on the bottom axis, I've got the levels of the top 40 index. And then on the left-hand axis here, I've got the profit and loss. Obviously, profit above the line, loss below the line. What we did, we went along and we bought two options contracts for the September expiry now, with a strike of 44,750. A call option in this case allows you to buy at a predetermined price at a future date, right? And for those options, I paid 15,000 Rand for each of them, which came out to the total cost of just over 30,000 Rand for those two, right? It's a lot of money to pay. So what I did is I paired it off and I went and I sold out the money put options. I sold 4 contracts of the September Aussie 41,750 strike put options. I receive premium when I sell short an option like this. So I've received 7,431 for each of these options. With 4 of them, it means that I received a total of 29,724 Rand. Now, you'll agree that the premium that I've paid away on this call option is pretty much offset by the premium that I've received on this put option, right? So they're more or less self-funding. If you overlay those 2 option strikes together, you get that yellow line as your payoff. That's what we actually would typically call a call spread. So you've got upside, to the right-hand side here, if you like, and then there's flat in a certain area, and then there's downside if the market falls below that bottom strike. Right, but now I put this on with the intention of it being a bearish structure, looking to give us some downside participation if the market should fall.
So a hedge, essentially.
A hedge. So if I just tidy the graph up, right, there's your payoff profile of the typical call spread. But as I said, because we wanted this to be a bearish structure, in other words, I wanted to be able to participate if the market was to fall, but if the market should carry on rising, I didn't want to be naked short, as it were. So what I did is I then went against those 2 options that I've now just explained, and I went short of 2 September futures contracts. Okay. And I did that at a level of 44,650, and we've been sitting short of those 2 futures the whole time for the last 4 or 5 months. If you now take those 2 payoffs that are on the screen now and you overlay those 2, you then get that orange line. And what you can see is that the loss that we would incur on our short futures position if the market continues to rise gets offset by the profit that we'd make on the call spread option structure there, resulting in effectively zero. No gain, no loss if the market stays strong. All right. If the market falls below our strike price here, below effectively 44,750, then this structure starts to make money. All right. Now, let me tidy this all up a little bit. There's the net payoff of this overall structure that we've been talking about now. These are the parameters and how it basically looks from here. Above 44,750, we stand to lose 3,400 Rand. We can't lose more than that. That's the maximum, effectively, insurance premium that we've paid, if you like. Below 44,750, this structure then starts to make money. And at a level of 41,750 on the top 40 index, we'll make our maximum profit, which is 56,000 Rand. Right, below that, the market, the structure then starts to gradually lose its profit, and we'd only actually start to lose money below 38,750.
Which is a hell of a long way from where we are now.
It's very far away from where we are now. But to give you an idea, we're up here somewhere at about 46,000 at the moment. So we out the money on this whole thing at the moment. But the point is, we've got 13 trading days left until the futures close out. A lot can happen between now and then.
Sellers.
And well, yeah, come on, sellers. Or alternatively, we could also use this structure as a protection to buy against if we do see any near-term weakness. If I go back to that top 40 futures graph now, so this is now back at the chart that we looked at previously. What I've got on the right-hand side here now is an area where I can actually overlay that options payoff onto the top 40 graph. So there you have it. The pertinent strike levels are 44,750 at the top, 41,750 in the middle, and 38,750 down below. Notice that above 44,750, my loss is defined effectively to the premium that I've paid away on this option structure.
Yes. So there'll be no surprises there.
There'll be no surprises there. The market can go to the moon, and I can't lose any more than that 3,400 Rand that we've paid away as an option premium. However, if the market starts to fall, then we start to benefit quite nicely. And our maximum profit would be generated at 41,750. Now, look, the reality is I think that's too far away now. Given that we're so close to the futures closeout, the prospect of us falling into that zone, I think, is extremely remote. So the thing is that this area, this 45,000 area, or the 44,750 where we've got our major option strike, it could become interesting if we see the market start to fall and drift back into that sort of zone, because what we could actually then do if we wanted is go and do some buying, knowing that we've got an option structure that completely protects us if the market were to fall further. So it leaves us with a number of possible options that we can explore. Either if I'm very bearish, I think I can leave this thing to just try and fall into the profitable zone, or alternatively I can use it as a hedge to go and buy against. Anyway, we've only got 13 trading days left of this thing, and then we'll need to, within that time, we might have one or two of these possibilities coming up for us.
I have to say though, and there's something almost masochistic about this, because I'm generally long of everything in the market, but I almost wish the market falls, just so, because we've had these structures and we've just talked about it before, we've had these hedges in place and we've never actually, we've never really made money from them because the market hasn't fallen in a heap. But it would almost be nice just for this to work, Garth.
Yeah, look, I think there will definitely come a time at some stage where we'll be on the right side of these options. Remember, we've been in a bull market now for 5 years. So I've probably been doing these option structures for the last 2 years, putting a bit of downside protection in every quarter. And it's like insurance. So if the market doesn't fall back, well, it doesn't matter, because it doesn't cost us much to put a structure like this on. But if and when there comes a time where the market stages a really meaningful correction, we could very well be sitting quite pretty with one of these structures on. And that's why I'd like to continue doing them each quarter, because I think at some stage there will come a time where one of these will work nicely for us. And also, we alluded to it last week on the birthday show, saying that we've done really well over the last 5 years, but it's been a bull market. What's going to happen when it becomes a bear market? And I think by employing these types of structures and these sort of strategies, this kind of lines us up to do okay in a bear market if and when we see one.
Garth, to end off very quickly, quick look at how the portfolio stands and then your next course date.
All right, well, the portfolio looks pretty much identical to last week, because we've had no other long positions. All of these previous trades have been closed out. There's our option structure that we've just discussed now on this show. So really, we're sitting the same, 331,000 Rand. That's up 32% for the year to date.
And then upcoming course dates, in fact, it'll be, next week?
Well, this week, Saturday is the first one in Joburg, but that's fully booked. And then I'm busy every single weekend throughout September now. Each of the Saturdays I'm in Cape Town, Durban, and then at the end of the month I'm back in Johannesburg again. This is still on our 5-year promotional price, so it's 1,490. Anybody that would like to attend one of these courses, please email me, garth@traderscorner.co.za, and I'll send you the details.
Okay, great. Garth, we'll leave it there, and we await with interest what happens in the market. Thanks as always for joining us. That's Garth McKenzie, founder and editor of Traders Corner.
Traders Corner is proudly brought to you by IG, the specialists in CFD trading.